Good afternoon, everyone, and welcome to the first installment of Mercadien's four-part M&A webinar series titled Maximizing the Value of a Privately Held Business. I'm Frank Pina, a managing director with Mercadien, and I have the pleasure today of introducing our speakers and moderating today's session. Our first webinar will consist of a deep dive into the state of the capital markets, middle market M&A activity in our region, and an M&A outlook for 2021. Today, you'll hear from three M&A experts from the investment banking, financial advisory, and legal arenas who will share their insights on these topics. Our first presenter, Valentina Medora, Senior Managing Director of BDO Capital Advisors, will provide an update on the marketplace and share her vision on the middle market transaction activity in our area over the next 6 to 12 months or so, with consideration given to the change in administration, COVID-19 pandemic status, tax policy changes, industry sector valuation trends, and related impacts. Valentina brings with her more than 20 years of investment banking experience when it comes to advising privately held and family-owned businesses with respect to various transaction structures, including leveraged recapitalizations, shareholder transitions, management buyouts, exclusive sales, corporate divestitures, and private placements across various industries and sectors. When Valentina concludes her presentation, we'll flip the script to a panel discussion where your questions will be addressed by Valentina and her co-presenters, Lee Boss of Mercadien and Rachel Stark of Stark & Stark Attorneys at Law. By way of background, Lee Boss is the managing director with Mercadien, and in addition to his involvement in firm leadership and administration, he leads the firm's audit and assurance practice with a focus on business and financial consulting for privately owned companies. Whether it's advising on succession or strategic planning, bank financing, CFO coaching, or general financial management, Lee brings with him and draws upon his many years of experience serving clients in the manufacturing, professional services, construction, real estate, and not-for-profit sectors. Rachel Stark is a shareholder at Stark & Stark Attorneys at Law and a member of the firm's banking and financial services, business and corporate, intellectual property, and non-for-profit organization groups. Rachel concentrates her practice in the representation of startups and emerging growth companies, not-for-profit organizations, and other privately owned companies, consulting on a variety of issues from corporate formation, financing, franchising, licensing, acquisitions, as well as real estate intellectual property law. Rachel also represents lenders in commercial loan transactions. So why are we here today? As middle market business owners in today's economic climate, it's really important to stay informed and be aware of your options. Today's session, followed by future installments as part of this webinar that we have planned over the next few months, is intended to help business owners like you do just that. Before I turn it over to Valentina, I just want to make mention of a few housekeeping items. First, feel free to submit any of your questions through either the webinar's live chat feature or through the Q&A feature as part of this webinar so that our panelists can try and cover as many of your questions as they can during the time frame allotted. And of course, if you're interested in receiving CPE credit for today's session, just be aware that each participant has to log in individually using the link provided to you via email, as well as successfully answer 2 out of 3 of the polling questions that will appear on your screen throughout the presentation. And then upon completion of today's program, you'll receive an event evaluation via email, which you'll need to complete and email back to us at solutions@mercadien.com. Within a week or so, you should receive a CPE certificate via email. Thanks again for joining us. And with that, I'll turn it over to Valentina to kick us off.
Thanks, Frank. So, just to start off, we're usually asked by selling shareholders, what is the right time to sell your business? And we try to focus on 3 factors to answer that question. The first is, what's the economic climate and where are we in the M&A cycle? Then we look at the industry performance. So are we up against industry headwinds, or do we have tailwinds at our back? And finally, making sure that we're selling the company at a time when it's maximizing its operational performance. Today, we're going to focus on the first area. So taking that deep dive into the economic and capital factors affecting the M&A market. And, I think what you see on this first slide here is we've kind of shown you the M&A market 2020 by the numbers. And, some of these numbers are good and some of them not so good. But generally speaking, while 2020 was an unprecedented and unsettling year in many respects, M&A was absolutely a bright spot. If we look at overall deal volume, it decreased by about 21.6%. That's largely a function of the paralysis that we faced in the second and third quarter. That was normalized by the fourth quarter and certainly gave us a lot of visibility coming into 2021. And we saw a similar effect on private equity transactions. So they decreased 21.1% year over year as well, largely because of that second and third quarter negative impact and lack of transaction activity that we experienced. And if you look at the PE world, they were absolutely paralyzed trying to deal with internal portfolio risk mitigation and effectively suturing their portfolio companies with PPP loans and any sort of other capital they could give them. So they had their hands full and weren't out there transacting other deals. But there were also very positive developments throughout 2020. One was definitely the average debt multiple. So we look at capital or credit is the lifeblood of M&A. And here, although we had a drop down to 3.7 times debt to EBITDA multiple in the second quarter, that rebounded really nicely to 6.3 times by the end of the year. And that capital positions the industry very well for deal making. On top of institutional capital, we also have about a $1.4 trillion PE overhang from the private equity world, which was there and available for deal making. And probably the most surprising statistics on this page that we can see are the increase in valuation multiples that we experienced throughout 2020, which, one would not think that we'd have an increase in multiples during a pandemic, but that's exactly what we saw. So the EBITDA multiple paid for companies between 25 and 50 million in enterprise valuation went up from 7.5 times to 9.9 times. That's almost a 2.5 times difference. And then the average mid-market multiple paid for companies between 10 and 250 million remained at about 9.3 times. We're going to dig into some of the reasons behind these multiple increases, but certainly, very positive numbers to negate the other things that occurred in 2020. So the story for us in 2021, it's that of economic resurgence. We've got lots of dry powder, restoring favorable credit conditions. We've got a stabilized government, hopefully, improving COVID situation, additional government aid on the horizon, and historically lowest interest rates. And that's just a great backdrop for M&A, and hopefully we're going to see that throughout 2021. So, we talk about economic factors. Let's start looking at GDP growth and consumer sentiment. So after experiencing negative growth in the second quarter, really that which mirrored the Great Recession, we saw US GDP grow at 4% in the fourth quarter, and it's projected to decline to 6% in 2021. There are some lingering concerns around inflation and the pandemic. You've got these variant viruses that people are concerned about. But generally speaking, the US economic health, it's an important influencer of capital markets activity because it gives us confidence. And that's what we have right now. We have confidence in the marketplace. And some of that has been built in by some positive figures we're seeing in unemployment rates. You can see that the unemployment rate experienced an improvement in the fourth quarter, 0.8%. And we had wage increases of about 3.4% year over year, ending the month of February. And that confidence is exactly what the M&A market needs to transact deals. Now, the one caveat here is that typically what we've seen with our clients most recently is supply chain disruption. And those companies that are reliant on sourcing product from overseas now have such a significant amount of demand that they can't fulfill their orders. They're trying to navigate around that by doing, aircraft freight services and trying to get product over to the US as quickly as possible to meet delivery timelines. But essentially, that is the one problem, probably a good problem to have, which is, increased demand, but certainly something that, most of these companies are being challenged with right now. With a positive economic foundation, confidence has further been fueled by exuberant, stock markets. And it always surprised me how well the stock market was performing in the face of the pandemic. But what we have is we've got the Fed's liquidity injections, which kept the gears of the economy turning during the pandemic, and certainly, the equities indices. And here what you're seeing is the Dow Jones, NASDAQ, S&P 500, and the Russell 2000. And when we go back to January of 2020, you can see that the NASDAQ was performing very well. And throughout the whole pandemic, that index was performing exceptionally well, largely because of some of the larger tech companies that make up that index, like Amazon or Apple or eBay. But nonetheless, the tech-heavy NASDAQ index did exceptionally well. What you may not be as intimate with is the Russell 2000. And the Russell 2000 is an index that actually is a better indicator to us of investor confidence in the marketplace. The Russell 2000 is made up of all small cap companies. They're typically growth companies, and they're very risk related. So usually in any sort of down market, we see the Russell 2000 index perform poorly, as evidenced by where the index sat, back in April of 2020. And then as consumer confidence grows, as investor confidence grows, we see more people investing in that index because of the return parameters that they can actually realize. And so what we realize here then is that the Russell 2000 index is an indicator that the market is actually very confident in what will happen in 2021. In addition to the market confidence, what the market indices also give us is currency. And what we're seeing here is that as the market continues to perform, the stock prices of publicly held companies continues to go up as well. And those publicly held companies are affording us consideration for our clients' companies. And so what they're doing is they're increasing the ceiling by which those multiples can be paid to the sellers without having a dilutive effect on the shareholders. So, this is really twofold, that we've got confidence in the marketplace. We also have currency, and we have this publicly held acquirers that now have a lot of capital to put to work. Oops, bear with me. Okay. And, another thing we have to consider then too is looking at the overall activity of the marketplace and where we are in the M&A cycle. And this is very important, I think, for shareholders to have a perspective on. So, despite the solid economic footing that we went into in 2020, we actually had already started on a precipitous decline in M&A activity. And you can see this starting in 2018 and working through to 2020. Now, why is this important for us to understand? Well, the way that the M&A cycles operate is they typically have 2 to 3 years of a trough or decline, and then you have 3 to 5 years of an uptick, and eventually you achieve an apex, which we can see in 2015. And so where are we in this M&A cycle? Well, actually pleasantly surprising, you've got this downward trend between 2018 and 2020, which most people believed was a prediction of a broader economic slowdown. We actually always thought we were going into a recession in 2020. We just didn't think that it was going to be pandemic induced. And no one really predicted the speedy recovery that we're experiencing. So we actually believe now we're working through the trough, and we're going to start to have an uptick starting in 2021 and hopefully approaching an apex in 2022 or 2023. If we look at that particular time frame as we move through 2021, we expect various surges of deal flow beginning in Q1 for pandemic resilient companies, so not all businesses. And then we should achieve some normalcy meaning pre-COVID levels by the end of the second quarter. And I think that's going to align well with where the supply chain disruption will work itself out as well. The other factor that we need to take into account here, though, is the potential increase in cap gains rates. So if you see on this chart, 2012, that was the last year that we had a capital gains rate tax increase. It went from 15% up to 20%. And the M&A activity in that year increased approximately 20%. And that was because sellers were trying to preempt the tax change. We're going to experience the same thing in 2021 with Biden's presidency and talk of increasing the capital gains rates tax, and it could be quite significant. We have a lot of sellers that have already been considering a sale and now are trying to preempt that change in tax policy by selling throughout 2021. So really you have this coalescence of pent-up buyer demand, an abundance of capital, free-flowing credit markets, and anticipated capital gains rates. And all of those factors together are creating a really nice backdrop for 2021 and the activity that we're going to see. And similarly, if we look more regionally into the Northeast and what's happening with businesses, we saw a very, very similar trend in to what happened in the broader market in the Northeast market. So you can see the dip that we experienced in Q2, Q3. You can see the transaction activity that is now picking up in the fourth quarter. And what's probably not evident from this slide, but is important, is that the sub $100 million enterprise valuation segment made up 68.7% of all M&A activity. That was the highest percentage mix since 2016. Now, why did that happen in 2020? It really has to do with risk aversion. So size begets risk, and where we have risk aversion, buyers will move downstream into the lower middle market. Those deals are easier to absorb. They're easier to finance, especially when the credit markets aren't freely flowing. And those are deals that we're getting done in 2020. We do expect that to continue throughout the next several years, and that percentage of activity to be strongly accounted by those deals less than 100 million. Another bright spot, as I mentioned, was valuation. So let's take a closer look at the valuations here and what happened in 2020 vis-a-vis, the past years and what sellers should be considering. It seems as though what the pandemic did was it purged the market of questionable business models or non-resilient companies. And so those remaining were afforded a scarcity premium. Effectively, there was still capital in the hands of private equity firms, in the hands of strategics, but there were less good quality assets that were performing in the pandemic. So what we saw was that in the middle market, M&A average valuations fell to 7.77 times EBITDA in Q2, the lowest middle market value since 2009. They jumped back up in Q3 to 8.1 times, and then ended the year, back at their average of 9.3 times for all segments of the middle market, up to 250 million. What that really underscores is market resilience of these businesses, but then also it reflects a generally higher quality deal mix during these uncertain times. And if we look more closely at the segments, so the lower middle market, deals between 10 and 25 million, that multiple increased just about 1 times to 8.7 times. And then the 25 to $50 million segment received the most attention and the highest multiples here at about 9.9 times. That was an increase of 2.4 times. So just to put that into perspective, if you have a company that has 5 million of EBITDA, that company now getting 2.5 times multiple more of value is effectively $12.5 million of purchase price consideration. A $5 million EBITDA company operating in a commoditized manufacturing industry is probably a 6 times multiple. That's a $30 million transaction. For that company to grow into an additional $12.5 million would take significant capital and significant amount of time. So these are the types of decisions that sellers need to consider. Maybe, given the multiples, it's the right time to go to market and take advantage of these higher prices. And the other thing we need to consider is, where are these multiples, being allocated from an industry perspective? Because not all businesses, and I just, referenced a commoditized manufacturing company, you're not going to get 13 times as a manufacturer. But in certain industries, and you can see here, we kind of highlighted the most highly favored industries throughout the last couple years: business services, healthcare services, and IT were really those industries that experienced a lot of attention from both investors as well as strategic buyers. Interestingly, if you look at the bottom chart, the activity of technology companies really dominated all activity. And so technology deals became the darling of the pandemic. And that was really, and I'll even, drill down further, not just technology, but in the software industry. The global software market remained very resilient throughout 2020 and in fact thrived because of the remote technologies required to enable people to work from home. And what it did was it established this further divide between prospects facing the software-enabled digital-first economy and the physical economy. And that activity was further fueled by the public markets. They were supporting IPO activity. We had a record number of SPACs. Can't imagine you can open up the Wall Street Journal these days and not hear of, a new SPAC originating. And in addition, we also had that private capital, the PE world, increasing their appetite for software assets. So again, that's a sector that has performed exceptionally well throughout the pandemic. And we saw that also in the Northeast. So, similar types of trends to the broader market when we looked at these industry segments: business services at 14.2 times, healthcare at 13.2 times. And you can see actually locally, IT companies or technology companies were up near 20 times multiple, which is very, very significant. Little bit different when you look at the activity though, because the activity was actually concentrated in information technology and industrials. So again, it just gives you a better picture of what's happening locally in the Northeast region. I can tell you just from closing deals, I had a couple deals that closed in the Northeast region, and at least one mirrored what was happening in these multiples. It was a software company that was focused on EDI software, and that closed at about a 17.3 times multiple. So, this was the height of the pandemic when we were closing these deals, but there was a lot of attention and a lot of attraction to these software companies that were able and facilitated, working through the pandemic. So who's buying businesses right now then? I guess is one question that people always ask. And the pandemic affected businesses quite differently. If you look at privately held companies, again, it becomes a question of risk aversion. Privately held companies are typically going to be less aggressive in M&A than a publicly held company. And you can see that the volume of privately held deals decreased by about 33% year over year, where the value increased about 6%. Publicly held companies, however, their mantra is to grow through acquisition. So they only experienced about a 17% year over year decline. And that's largely a function of the fact that, again, they had access to the equity markets and capital to continue going out and doing acquisitions. And they continue to have that confidence because of their stock prices and because of how well their companies were performing. So what we did see was that buyers with strong balance sheets remained in the game. They completed most of their in-process transactions, even though they had headwinds from, due diligence or financing challenges. And then other buyers were underwriting M&A deals on more of a defensive M&A play. So they were paying full multiples for solid businesses that were less impacted by the pandemic. And those are two buyer constituencies. If we then shift gears and we look at, the private equity world, that's another buyer constituency that, obviously has been very, very active over the years and warrants, some discussion here. So when we look at this chart, we're comparing the number of deals done by financial sponsors versus strategic buyers. And I can tell you that countless times I talk with shareholders and they always presume that the only deal available to them is a sale to a strategic. Well, that's changed significantly over the years. Private equity firms have become, much more of an available type of deal structure. People understand it more and are much more willing to embrace it as an exit strategy. And there's really three reasons for that. One reason is the structural flexibility. So sellers are able to sell a portion of their company, retain some ownership. They could invest or reinvest in Topco or Portco. It gives them different levels of diversification of probably their largest investment holding. The second reason is capital availability. I mentioned the $1.4 trillion that they have available to them. And finally, pricing. They're being extremely competitive in their pricing. And you can see this throughout 2020 because the PE firms were focused on growth capital transactions, SPACs, PIPE transactions, portfolio add-ons, and this was all to try to circumvent what's happening in the pandemic. So we find that they're extremely flexible and can do those deals. And this is really a subject matter that we'll touch upon as we move through this 4-part series, because you could probably dedicate a whole webinar to it. But the private equity firms, as I said, they're much more prominent on the deal scene these days and offering shareholders a lot of different options in the way of deal structures. I talked about capital availability and how important this is. The amount of investable capital is a significant catalyst in deal making. And despite the fact that in 2020, private equity firm fundraising did decline, they obviously weren't out fundraising because they were dealing with their own portfolio companies. What they did have was they had $1.4 trillion of dry powder available to deploy in deal making. Now, what's important to recognize is that in order to execute a private equity leverage recapitalization, you also need credit from institutional banks. So they kind of go hand in hand. Private equity firms can over-equitize a deal for some period of time to offset lack of credit available from the banks. But we really found that it was really the second, third quarter where the banks were shut down. And as they started to reopen, and with the private equity firms having this $1.4 trillion available to them, they ramped right back up and were out on the deal scene, conducting a lot of transactions to close out the year. So where are the PE firms focused? I would say it's probably a very similar trend to what we saw in the broader market. Deals valued between 100 and 250 million made up about 75% of all deal value. But then if we look at the actual activity, deals less than 100 million are in that bracket, as you can see on this chart that's made up in the blue column. Those deals made up about 73.6% of all deal activity. That was up about 2.2% over 2019. And was actually the highest recorded number on record. So again, these private equity firms are looking for add-ons. They're looking to build out their portfolio companies, and they're targeting these businesses that are less than $100 million to transact deals. And that's what's been extremely important now for selling shareholders to consider as they work through their exit options. I mentioned the buyout activity and looking at add-ons. This is an important consideration for private equity firms, and it's changed over the years quite significantly. So taking us back to 2006, when we look at 2006, we can see that 46% of add-ons were conducted in that year, and that's grown to about 72% in 2020. So almost a 30% increase there. And that's largely because those add-ons, again, could be conducted in a downturn or an upturn, but also because it affords us some financial engineering. And I'm just going to flip back here to a previous slide and talk about valuations in that financial engineering so we can understand it a little bit better. If we look at the average deal multiple that I referenced for all deals, that average deal multiple is about 9.3 times. And you can see here that private equity firms, for their leveraged buyouts, they're paying upwards of 14.1 times through 2020. That's up from 12.7 times in 2019. Now, there's a couple of reasons for that. The first is that PE firms have pivoted their strategies away from the ephemeral and toward what they believe will sustainably succeed in the post-pandemic markets. And this is very important because what it's moving them more towards are technology deals or tech-enabled deals. Deals where you have SaaS models, where you have predictable income, and can look at the visibility of these businesses over the course of 6 to 12 or 18 months, as opposed to 60 to 90 days. When they get the confidence in those types of businesses, they're willing to pay 14.1 times. Secondly, as they move away from capital-intensive businesses to tech deals, they also are afforded more liberty in the types of deals they look at. So if you look at where private equity firms used to invest back in 2008 or 2009, they were largely focused on manufacturing companies. And over the years, they moved into these different sectors, and those sectors simply command and are afforded a higher multiple. So as private equity firms focus more on healthcare services and technology deals, we're going to start to see these multiples continue to grow over time. The other thing, which is a little bit more of a recent development that we've experienced, and we certainly saw this in our deals that we closed over the last 6 months or so, is that private equity firms look to financial engineer some of their deals. So they will buy a portfolio company, and they will look then to do these add-ons. As I mentioned, they're upwards of about 74% now in add-on activity. And the way that they financially engineer these deals is they may buy a portfolio company at, let's say, a 10 times multiple, an average multiple. And then they go out and they'll do a deal where they buy an add-on at a 5 times multiple. They've now experienced an arbitrage of 5 times on the EBITDA of that portfolio company. If that EBITDA or that portfolio company is a $5 million EBITDA company, they've generated $25 million of value for that company, and they probably have not paid $25 million for that company. So that is what they're trying to do. They're trying to get that arbitrage value that they create by adding that company, that bolt-on, onto their existing portco and then turning it around and flipping it. And we experienced this with some of our deals where, I had actually 2 deals, one where we sold the company, I think it was on a Friday, and by the next Thursday, the private equity firm had sold the portfolio company that acquired our business to another private equity firm. And so they had expressly acquired our client for the purpose of then, flipping that investment and being able to realize the arbitrage opportunity on that investment. And then we also had a building products company that was purchased by a strategic firm that was owned by a private equity firm, and they ended up actually selling to another private equity firm throughout the course of our deal. So, these portfolio companies are going out and they're building up these acquisitions because they want to appear more valuable. They want to have a growth scenario that they can, or a narrative that they can then sell to a potential buyer. And what that affords them is the ability to pay more for the company. So at the end of the way, the message here is that private equity firms in some situations will pay more than strategics, and absolutely should be a consideration when selling shareholders are looking at potential buyers and what sort of exit strategy they should consider. The one impact of the pandemic, and something to realize, because sometimes when selling shareholders are considering a financial transaction with a private equity firm, they don't realize that in most cases, you're not just selling out like you would to a strategic. You don't close the deal and walk away after some sort of transition period inside of 6 months or so. In this case, they're buying into the management team. So whereas back in 2006, we probably saw a whole period of 0 to 3 years, these whole periods have extended over time. And it's really extended because of the investment horizon of these private equity firms. So they are typically looking at an investment term of 3 to 5 years or 5 to 7 years, with those first few years of where they buy into the investments. Then they do all their add-on acquisitions throughout the course of the next few years. And then they start to evaluate their exit strategies in the last couple of years. And those exit strategies can either be a sale to another strategic, a sale to another private equity firm, or a public equity or public offering exit strategy. And so we actually believe now that the pandemic is probably going to move out some of this, some of these years. That 3 to 5 will probably extend more to 4 to 6, because some of these pandemic related businesses are going to have to retrofit their business models, move to more online offerings, and that may take a longer period of time to ready them for market. So we may see this extend, I wouldn't say it'd be more than a couple of years, but again, it's important then for selling shareholders to recognize that, because instead of thinking, okay, I'm going to wait till I'm 55 to sell my company, I'm going to sell it and walk away, you have to kind of factor in those extra years that you may be with the private equity firm, if that's the direction that they take, and factor that into the overall shareholder time horizon. Finally, I just wanted to look at, a kind of a dive into some of the sectors and where we see buyers are interested in kind of affording most of their investment dollars and their attention. I've talked a lot about technology in this presentation. And, look, this is where a lot of the investment dollars are going, both from a public standpoint as well as, from a PE standpoint. And there's a lot of opportunity in technology and internet and streaming services, specifically in software. We see digital and telecommunications, and the focus here is all the move to cloud computing services. So remote working technologies, cybersecurity, fintech, any sort of those segments are getting a lot of attention. Business services, I've also mentioned, and between business services, consumer products, logistics and transportation, those businesses that provide products and services to warehouses or delivery mechanisms to the home, or even online education. Again, we're going to see a lot of investment dollars go to those areas. And the reason for that is, if you look at business services and you look at the financial profile of those companies, they typically have recurring revenue, they have a scalable margin profile, and they're oftentimes in fragmented markets where private equity firms can conduct roll-up strategies quite easily. Mom and pop shops pull them together and then sell them as a larger entity. So really for us, we see key themes in 2021 as being customer acquisition and business operations in a virtual environment, e-commerce platforms and digital visibility and reach. And probably those out of favor sectors are going to be automotive, entertainment still for some period of time, and then retail before it really does come back on in full capacity. So, just to conclude then, as we look at this, 2 takeaway points. One, the markets are thriving, and they are affording sellers a very strong foundation right now to go out with very competitive valuations, a lot of capital in the marketplace, and confidence by buyers to go out and do transactions. And secondly, the capital gains rate taxes or potential tax change is driving a lot of the baby boomer population to consider a sale at this point in time. They've lived through 3 market cycles and 1 pandemic, and anyone that's lived through that is fatigued, most definitely, and looking to set their priorities differently for the balance of their lifetime. And these are conversations we're having with shareholders currently, and this is what they're telling us. So if time horizon is optimal and if companies are performing, now is really an opportunity to try to take advantage of where we are coming out of the pandemic, approaching now, a revival of the M&A marketplace and working towards an apex and thinking through, an optimal time for selling shareholders to consider some sort of liquidity event. I will pause there then and turn it back over to Frank.
Great. Thank you, Valentina, for that informative and encouraging presentation. At this point, we'll move to the panel to address some of the questions that came in through members of our audience. The first one I'd like to toss over to Rachel. It's more legal in nature. Rachel, how has the high volume of M&A activity in certain sectors affected the way that transactions are being handled from a legal perspective?
Yeah, thanks, Frank, and thanks for that presentation, Valentina. I can attest to the high volume, from the many hours that we're all working in the last couple of months, which is exciting, for our clients. Yeah, I mean, in terms of the changes in the way that things are being handled on the legal perspective, there's just a much shorter time frame from the time a deal comes into closing. And so because of that, from a seller's perspective, really being ready to take that opportunity and go is really important, because ultimately the buyer is going to want all the same protections that they wanted before, but they're going to want, and as Valentina described, maybe there's an opportunity because there's, certain timing that they want to have closed a transaction by, and you need to be able to fit in within that time frame and be ready to close. So, from a legal perspective, the biggest issue is just that things are happening much more quickly, but with the same, legal constraints. So being ready is really important.
So Lee, from your standpoint, looking at it from the buyer's perspective, how are buyers factoring the impact and outlook of COVID and what everybody describes as the new normal into their valuation, their deal structure, and any deal terms associated with the sale?
Yeah, thank you, Frank, and thank you, Valentina. I just want to echo what Rachel said too about very informative, insightful, and definitely seeing a lot more transaction and deal flow from our side in the financial world. Yeah, we've seen, it's interesting on the buyer side. I think it really highlights a lot what Valentina marked is that, for certain industries and sectors, we're seeing a really lot of activity and a lot of interest. Businesses that were poised well and did well through COVID and are resilient. We're seeing a lot more multiples, really a lot of interest and activity there. And on the seller side, there's a lot of interest on those type of companies to start, even if they weren't exploring a possible sale transaction, to, test out the market and see, what it looks like for them. Because I think there's this sense that, things are really strong, as, Valentina indicated, in some of those industries, those multiples are really fantastic. I've worked with a few clients where there's been a lot of concerns because 2020 was a down year, for a number of reasons, obviously the pandemic being the largest driving force for that. And, as they're preparing to sell, EBITDA has been down. So often, there's like a 3-year multiple that's done, 3-year average on EBITDA when buyers are looking at evaluating that. There's a lot of, 2020 was a down year. How do we factor that into our transaction? I've seen a few where, they've given a less consideration up front and more earnout type provisions, or that's at least what their initial offer was, to try to, adjust for that in the earnout provision. So as the seller, you're getting less cash up front and, that uncertainty going forward with the earnout, but the buyers, proposing to do better on that because, if things turn out, better, they're paying less for it, but then they're going to make up for it, with enhanced EBITDA going forward. So those are some of the things that I've seen on the buyer side, but definitely a lot more focus on, the due diligence and surrounding, in particular, the related COVID impacts to that business.
I might just actually echo Lee's thoughts here and add a point. What we've seen and what we've tried to do too, when you're challenged with a down year because of COVID, is isolating those expenses and then having them as actually a positive or negative impact to EBITDA. So in the case where really the company experienced significant tailwinds, we don't think it's going to be sustainable. We actually have put in a negative add back, because you've got to normalize the EBITDA, but equally so where there have been extraordinary expenses the company had to incur to adjust their business, manufacturing facilities, anything like that. We've put in a positive add back for that. And buyers are, they're open to that. What they're primarily concerned with is what is sustainable EBITDA going forward. And so they will be very amenable to adjust the EBITDA for those add backs. But again, it kind of cuts both ways. So sometimes it, with the Lord taketh, the Lord giveth it away as well. So you've got to kind of deal with that.
So you just mentioned due diligence. Rachel, from your standpoint, are there any particular issues that or new focuses of due diligence in M&A transactions that you're seeing in light of the environment we're in? And how does that play a role with respect to PPP loans or other COVID-related relief that companies were given over time?
Yeah, I mean, the PPP loans are an issue for every deal, obviously since April. So, the two questions are, number one, assuming that forgiveness hasn't already occurred, do you have to pay back your PPP loan because maybe the buyer doesn't want to have that, lingering for, from their perspective. Number two, going through the process of complying in terms of putting the PPP money in escrow until forgiveness is received. And that is definitely a timing issue because you would need to communicate with the PPP lender and make sure that all occurs prior to closing. So you want to make sure that you handle that way in advance to get that done. On the due diligence side, I think the biggest issue that we're seeing that's kind of new in 2020, related and unrelated to COVID, are really, data security and privacy being a real focus of due diligence. A lot of times for, smaller companies who have just kind of run their business and they haven't had that huge focus on making sure that they've got, proper policies and technology and all the legal aspects in place on that can kind of be something that comes back to bite them in the due diligence process.
So Valentina, I think it was you who mentioned the capital gains tax rate increase earlier on in your presentation. So with that in mind, are clients accelerating planned sales due to those expectations? And how common is that if that's the case? Or who should be worried about that?
Yeah, so the companies, first of all, there should never be one factor that dictates when a company goes to market. And I think I referenced the beginning of the presentation, we kind of look at three factors. The companies that are going to market now, they're going to be the ones that were probably already considering a sale. So I have a few businesses right now, I met with them prior to the pandemic, then the pandemic hit, and so we were put on hold. And they were already considering going to market. So what this has done is accelerated their decision to go to market, and most definitely now we want to close by the end of 2021, just to again preempt the potential change in those tax rates. But it's more of an acceleration, not a determination. So these businesses shouldn't go to market just because there may be a potential tax rate change. It could be that their business isn't performing, or as Lee said, they experienced a down year in 2020, and you can't sell a company on a down year. You've got to sell it on its way back up. So it really is just going to be those businesses that were already looking to sell. But I think there's also kind of an important distinction to make there then, that the people that are accelerating their businesses, they're largely entrepreneurial. So they're family owned, they're privately held companies. They're ones that would be personally affected by the capital gains rate change. And that is, they were already looking to sell for business reasons. The company was doing really well. The time horizon of the shareholders was there. It's different for private equity, because private equity is not going to sell a portfolio company because of a tax rate change. They're not going to all of a sudden say, we need to unload all these companies because there's going to be a tax rate change, because most likely they were anticipating that for a very long time. They're going to continue to manage their portfolio companies to sell them at the right time and take advantage of multiples, or take advantage of bolt-ons or whatever they can do. And what's actually nice about that is the two sides of the coin are actually marrying up really well. So now you've got a lot of dry powder that needs to be deployed, and you have some sellers now considering going to market because of potential tax rate changes that were already thinking about going to market, and now you can make transactions happen. So I think, again, it's gonna spur activity for those businesses that were already thinking about going to market. But I would be the last person to advocate for a seller to hit market because of a cap rates change, if that was the only consideration that was driving them into market.
Yeah, Frank, if I could just add on that, I
Sure.
completely agree with that philosophy. I mean, the potential tax rate impact changes are pretty significant. You know, you're talking about a 20% cap gain rate up to, you know, close to 40% or north of 40% when you factor in the, you know, the additional Medicare type taxes on that. So, I mean, just to put that in perspective, because we like to do math and numbers, right? You know, you're talking about you'd have to get a 33.33% increase in your multiple to cover that additional taxes. So, you know, but as Valentina mentioned, you know, there's also in our presentation highlighted, I think, some outlook that maybe the multiples are going up and will increase if we're in the trough and we're coming through that. So, you know, I don't think it's a one size fit all. It's definitely a consideration. But there's also, you know, hurdles to get those tax rates through, those increases through. You know, it's not a slam dunk. But I think, you know, the general consensus is, you know, likely those tax rates are going to be going up. I also kind of mentioned to, you know, our clients that are not like just looking to sell their business, but general succession exit planning. You know, there's also going to be some changes down the road they're talking about regarding the, you know, estate exemptions and gifting. So from an internal succession perspective, there's opportunities now that, you know, we have a number of clients. Actually, Frank and I work on with one now that we're doing about business valuation, because they're considering some gifting type strategies with the outlook that, you know, some of the estate exemptions are going to go down on a federal level. So yeah, you got to kind of look at the bigger picture in totality, but I don't think tax should necessarily drive your decision making.
It's a good point, Lee. One of our chat functions just lit up when you said the word taxes. So it's a similar question. I'd like to keep it with you for a second, if you don't mind. So income taxes for corporations are going up. How is that going to affect valuations for acquirers? That might be something you can kick off and then see if anyone else on the panel has any thoughts.
Yeah, I mean, I think from my perspective, Valentina might, from the purchaser standpoint, have more perspective on this. But, you know, increasing taxes mean that there's less, you know, net income, right, and less cash flow available. So, you know, generally an increase in taxes would mean that valuations would, you know, drop. But that's, you know, generally my my view on it, how that gets factored into the marketplace. And, you know, obviously the stock market is going gangbusters. So the view where, you know, even though taxes go up, things go down doesn't necessarily always jive in reality.
From a legal standpoint, a question just came in around labor, and it's essentially around the fact that there's plenty of furloughed employees and several government plans deferring labor taxes or offering credits. You know, Rachel, from your standpoint, how do you see those issues impacting deal flow?
Yeah, I mean, interestingly, I think if I think about the transactions I worked on this year, none of them were really distressed. So when Valentina was showing her slides on the healthcare and the, some of the manufacturing and technology, those were the deals I was working on. So I think it was, you know, pretty much the opposite in terms of employees. You know, the issues are really, how can we keep these employees, not how do we deal with the fact that they were furloughed. But yeah, I mean, to the extent that there are furloughed employees, and you have to address that, that would be something that's obviously going to be a seller liability that we'd need to work out in the transaction.
Comment just came in around.
Just Frank, before we go on to that, the other thing to note was that during the year, New Jersey had instituted a new law called the New Jersey WARN Act, which is stricter than the federal law relating to, you know, if you furlough employees, the notifications, et cetera. And that law kind of it ended up getting delayed because of COVID. So it is now in effect, but there was a period of time it was supposed to go into effect and it got pushed back for a period of time.
One attendee would like the panel's thoughts on inflation and how that may or may not drive deal flow going forward. Any
Yeah,
takers?
I can probably just address that. I don't think it's going to affect deal flow because people have been factoring, I say people, buyers have been factoring in any sort of potential, inflation impact in their models for quite some time. So the valuations have taken it into account already. Now that's presuming that you're going to have modest levels of inflation, if at all. To the extent that we experience something more significant, I think it'll have a negative impact on valuations.
So another question, this may be one for Valentina. So what's the difference between an investment banker and a business broker? And when should one be retained over another?
That's actually an excellent question. So, I think it's the applicability of our services to the selling shareholder or the selling company. Small size deals, I would say less than 10 million. It's very difficult to take those businesses and create a growth strategy and create a narrative for the marketplace then that will, if that company was valued at 5 times, it's going to be valued at 5 times no matter what I do. But investment banker is, and that's appropriate for a broker. So the brokers will go in, they'll write about a 5-page overview on the company, and they'll kind of spray that opportunity across the market and just try to get buyers to the table. They connect the buyer and seller, and then they walk away. That is not the type of transaction that we're looking for, that we work on. A traditional investment banker will work on a business where you develop market materials to present to the marketplace, and you do that by way of building a narrative around the company, working on building out a growth strategy, whether the company has that or not, and trying to develop the key investment considerations that are most attractive to buyers in the industry. And you actually go through a sale process. So instead of just spraying the opportunity across the marketplace, you will identify the most suitable group of buyers. You will present them with the information, and then you go through two stages: an indication of interest stage, and then a letter of interest stage, letter of intent stage, sorry. And that is all meant to increase competition, increase value. So just to kind of give you a quick example of that, we took a company that was doing a one-off and was valued at $42 million. When we ran them through the process and developed those materials and took them to market, we ended up getting them $52 million for business. So we can add that $10 million of value to a company like that, but can't really do it on the smaller scale. So business brokers are highly applicable and appropriate for the smaller side of deals. But as you get above $10, $15 million in enterprise valuation, it's really appropriate then to use an investment banker. Also because, we talk about these transaction structures, you're looking at private equity transaction structures, different types of consideration, seller financing. Those become very convoluted deals that you need assistance with.
Great. I think we have time for one more question. And the one I'm looking at now is probably one that Rachel can start with. So Rachel, can you describe any additional or enhanced reps and warranties that you would expect buyers to demand from sellers in the current M&A environment?
Well, yeah, I mean, in terms of, we discussed the PPP loan. So I would say that starting in about November, there was a, standard representation warranty relating to COVID. And it really goes to Valentina's point. What types of changes have your operations made due to COVID? And that could go positive or negative. So for example, one of my clients, their issue in November, December was that they were not able to actually supply enough to their customers. So, they're in the middle of selling their business, and you would think that's a good thing, but it was actually, they had customers who they had to turn away, who were their longstanding customers. And so that was something that we needed to disclose to say, we have this problem, which is kind of a, you'd think that's a good problem to have, but it, then it relates to, okay, is that just a blip? Or, so those are the types of things that are now being addressed. Now you went virtual. Do you have the security? How are your employees working? Do you have, one of the real focuses right now is on wage and hour law as it relates to people working virtually and people working across the country. how does that affect, you know, tax issues, payroll, et cetera.
Well, it looks like we're just about out of time. So thank you, Rachel, Valentina, and Lee. To close, on behalf of myself and my colleagues, we all want to thank you for joining us. We hope you found the information useful. If Mercadien, BDO Capital Advisors, or Stark & Stark can ever be of help to you, whether it's evaluating M&A options or tackling other business challenges, feel free to contact us. Our contact information can be found in today's slide deck, which will be made available to all participants. And be sure to stay tuned for the additional knowledge and insights from our team. Be aware that future installments of this webinar will be rolled out shortly, and they'll cover things such as strategic liquidity alternatives available to privately held businesses, sales transaction types and structures that you should be aware of, and maybe things like life after the sale and other tips and techniques from our M&A experts. So with that, have a great weekend, and thank you again. We'll see you soon.
Thank you.
Take care, everybody.
Thank you.